Hey, happy Tuesday. We're a bit late today with our video, but that's fine. It's time for Tuesday tips. So I want to give you guys today basically the concept of how do you take your house and turn it into your own bank, right? So I'm going to show you how, if you own a home, you can pay off your house in 5 to 7 years, okay? Be done with the mortgage, be done with the housing payment, and also then turn your house into your own bank so that you can invest for passive income. At the very end of the video, I'm gonna give you a link to a resource where you can actually get a free calculator that's gonna show you exactly how to do this. So be sure you stay tuned for that. All right, guys, so Tuesday tips. The average American right now has a 30-year mortgage, right? And it's if you own a house. Obviously, if you're renting, this doesn't apply, right? But even if you're renting, I wanna talk to you today about how do you as a homeowner eliminate your housing payment altogether and turn your house into your own bank and create a source of passive income without having tenants, without doing anything special, right? And then if you don't own a home, I want to show you how you can make home ownership potentially a good idea without having most of the reasons, the average realtor or mortgage broker is going to tell you. It's actually a bit different, right? It's not, get a house because you're going to save money on a mortgage or because it's cheaper than renting. It's actually a wealth building tool, right? And it might not be the reason you think. So the concept I want to share with you today is called a first position home equity line of credit. We just call it replace your mortgage, right? Anytime we've got a really long name like this, we talk about the sacred account. It's, high early cash value, dividend paying whole life insurance. This is a first position home equity line of credit. We just call this replace your mortgage, right? So let's start with those that own a home. So if you own a home, you have a conventional mortgage most likely, meaning you're gonna pay every single month for the next 15 or the next 30 years, right? On a 30-year mortgage, basically by about the halfway point of the mortgage, you've paid for the house, all the way over in interest. By the time you're done and you've actually paid the house off, you already paid for another one for the bank. Okay, if you look at the total interest paid over the life of your mortgage, you essentially paid for the house twice. Not only that, but the idea that we hear is, okay, well, your house is one of your greatest wealth building assets. Okay, show me how that impacts an individual's life in reality. Sure, you might have equity, but do you see anything from that? Okay, how does that help you other than having a number on a statement that you can point to and tell someone, I own that, right? Does that pay for you to travel? Does that give you passive income? Does that somehow, make you wealthier? No, it's literally just a number on a piece of paper, right? So this idea that we buy a house because, we have ownership and we get equity really is antiquated. And it hasn't really ever been true, at least since the 1930s. And the reason I isolate the 1930s is in the 1930s, the conventional mortgage was invented by the banking system and made popular. So the Great Depression happened, right? Banks all had what's called a bank run. If you look at Silicon Valley Bank, First Republic Bank, Signature Bank, that's the same thing that's happening now. People go and they pull all their deposits out of the bank, or they try to, and the bank doesn't have the deposits. The bank goes under, and essentially everyone loses their money and or the bank gets bailed out. Right, so this was happening in the 1930s. Now, prior to this, banks used a simple interest line of credit, not a mortgage. Okay, simple interest line of credit, what does this mean? This means that you have a line of credit against your house, you put money into it, right, to pay the mortgage down. And this case is not a mortgage, it's a simple interest line of credit, but you get what I mean. And then you can pull the money right back out again. It's a two-way loan. You can put money in, you can pull money out, okay? One aspect of this is very similar to a credit card. Right, so nothing else of this is similar to a credit card. I don't want you to confuse this with a credit card, but if you have a credit card balance and you pay down the card, you can borrow again, right? You can pull the money back out. You can use it for purchases again. So that's called a two-way loan. You put money in, you pull money out. That's a line of credit, right? Now, the problem with a credit card is it's a high interest rate revolving line of credit. The interest compounds and builds upon itself. Your minimum payments are less than what the interest is. Therefore, you never get out of credit card debt. I don't want you to identify this as the same thing as a HELOC because that part is not the same. What is the same is the fact that at a very low interest rate comparable, you can put money in, pay down the balance, and then pull that money back out. It's a two-way loan. And this is how people did this back in the early 1900s and prior, is they would usually have a farm. They would have a simple interest line of credit on the farm, and they would put money into that to pay that line of credit down. And then when they needed the money back out, they'd pull it out. They'd borrow it back out again. And so they used it as both their checking savings account and also their source of liquidity, their savings account. They'd pull that equity out of the farm or out of the house. And in that sense, they actually did have a wealth building asset. Because if I can borrow against my equity free will. I can do that whenever I want to. I could, expand my farm or invest or, make a larger purchase or whatever it is that I'm looking to do, right? Now, they switched it to the conventional mortgage. The conventional mortgage is a one-way loan, meaning you pay money into it, you can't pull that money back out, right? Once you pay your mortgage payments similar to a car payment, that money belongs to the bank now. You're not going to get it back out, right? So that's the one-way loan, the conventional mortgage, right? So we're telling you go back to what was being used prior. Now, by doing it, here's what's going to happen. You replace your mortgage with a HELOC. You replace your mortgage. You dump the money into it. So this now becomes your checking account. Okay, so all of your income, every single dollar you earn gets deposited into your HELOC, right? Now, what that does is it pays down the balance. Okay, when you pay down the balance, you save interest, it lowers your housing costs. So that's a win right there, okay? Now, you're gonna pay all your bills out of that once a month. Okay, so you pay your bills, you leave the savings in there, right? So you're gonna leave the savings in there, it's gonna keep your line of credit paid down, and every month you're gonna do that. You're gonna continue depositing 100% of your income into that HELOC, and that's gonna pay their loan down rapidly. And so when you run projections on this, if you've got good positive cash flow in your budget, you could pay your house off in 5 to 7 years, right? Now, some of you might be like, Jerry, why are you telling people to pay their house off? Well, hang on, I'm not telling you to leave it paid off. Okay, just hold your horses here. We're telling you pay it off, then you've got to pay it off home. You can borrow from that line of credit again. Okay, but what are you going to borrow for now? You're going to borrow for investing, passive income producing assets, right? Now, if I borrow, let's say that my loan interest rate is 6%, but I'm going to borrow and I'm going to put that into a real estate investment that maybe pays me 12%. That 12%, I'm going to be paying my line of credit down every month. Again, same concept, reducing my principal. All my income's going to go into it. It's still going to be my checking account, right? And what's going to happen is my effective interest cost is not 6%. It's more like 2 or 3%. Plus, I'm going to write that interest off on my taxes because it's now involved with an investment. So I'm going to reduce that interest cost to maybe 2 to 3%. Meanwhile, I'm earning 12% on real estate and my house is probably appreciating at 3 to 5%. Right? I just became my own bank with my house, but with my own house, I deposited money in, which is what you do with a bank. Okay, I borrowed against the asset, I borrowed against the deposit, which is what a bank does with your deposit. I loan it to myself, I put that into a real estate investment that pays me 12%, and then that money comes back around and it pays the loan back down just like with a bank, right? And now the only difference is in this one, which is different than the life insurance, I'm not a shareholder. I'm not gonna ever earn profits on that system, but I do get appreciation on my house. I do get the spread, the difference between the real estate income and the interest cost on the loan, right? Now, real quick, let's say you don't own a house. Okay, you're renting. I'm renting right now. The reason I'm renting is because I don't want to have to put up with a house. Okay, do you know the first thing people do when they buy a house? Projects. Let's fix the kitchen, let's paint the walls, let's do this, let's do that. And they go from extroverted production to introverted consumption, which is disguised as production. Fixing your kitchen is consumption. That's a you thing, not a them thing. So anytime you're spending your time on a you thing, you're not gonna make money from it, right? You need to spend your time on a them thing. So I rent right now, but when I am ready to buy a house, which is going to be when the numbers make sense and I can fully outsource every aspect of it. I'm not gonna lift a finger or touch a thing. I'm not mowing the lawn, I'm not painting the walls, I'm not fixing the kitchen, right? That's the point I would buy a house. Now, I would buy a house with a home equity line of credit. Okay, I'd put 10% down. I would then use the home equity line of credit instead of a mortgage, and I would turn that into my checking account just like we discussed today. Right? Now, this does prolong home ownership a little bit, but here's the thing. It's better that you put 10% down on a house. Okay, you're making a better financial decision if you're putting 10% down on a house. Yes, it takes longer to build up, but you have a lower debt ratio. Your housing costs will be cheaper. You've got more equity, right? As that house gets paid down and appreciates, you can start benefiting from that and doing what we talked about earlier in the video, okay? So this is called Replace Your Mortgage. If you want to learn more about this, there's a link in the comments. If you click on this link, you can learn more about Replace Your Mortgage. There's a calculator and an ebook that we can get you from the Replace Your Mortgage team, but you need to click on that link first, submit an inquiry, let us know. We can get you all those materials. Thanks for watching. Like, share, subscribe. See you next time.